Many dividend investors prefer ETFs that are diversified across the entire world. I get that completely because I invest the same way. With a global dividend ETF in your portfolio, you can lean back, stay invested for the long run, and simply collect cash flow. For long-term investors, a global dividend ETF is one of the easiest and most relaxed ways to build dividend income. Here in Europe, 3 ETFs are especially popular: the Vanguard Dividend ETF, the VanEck Dividend ETF, and this iShares Dividend ETF. In a previous video, I already gave you a short breakdown of all 3. But today's video is about a completely different global dividend ETF that I find very interesting. I'm talking about the iShares MSCI World Quality Dividend Advanced UCITS ETF. I'm personally invested, and right now I hold around 2,800 shares. Ever since I bought the ETF in 2021, iShares has made a number of updates, resulting in an investment that has changed quite a bit. In this video, we'll take a close look at what this ETF is all about. We'll also talk about the adjustments iShares made, because they help explain why the ETF performed the way it did, and what that means for dividend investors. And I'll tell you honestly what I think about this ETF and whether I would buy it again today. Quick disclaimer before we dive in: this is not financial advice, just my own opinions and experiences. Let's start with the basics. I'll pull the key facts directly from the official iShares website, because that's where you find the most up-to-date information about this ETF. So, today we're looking at the iShares MSCI World Quality Dividend Advanced UCITS ETF. This ETF focuses on a selected subset of the MSCI World Index. That means it holds dividend-paying companies from 23 developed countries, while emerging markets like China or India are not included. The ETF was launched in mid-2017 and has grown to around $1.3 billion, or roughly 1.1 billion euros. It is domiciled in Ireland, which is generally a tax-efficient location. The total expense ratio is 0.38%, which isn't cheap, but still acceptable for a dividend-focused ETF. It uses physical replication, so the ETF really holds the underlying stocks, and that's always my preferred approach. Another interesting detail is that the ETF is registered in a surprisingly large number of countries. Even some Arab countries are on the list. But that's just a side note. Here you can see the country allocation. About 50% is invested in the United States, with the remaining developed markets making up the rest. Europe represents roughly 30% of the total. For an ETF built on the MSCI World, that's completely reasonable. After all, the MSCI World Index itself has a U.S. weighting of more than 70%. Overall, the ETF holds more than 200 companies, which gives it a solid level of diversification. Now, let's take a look at the top 10 holdings. Right away, you can see that technology plays a major role here. NVIDIA, Apple, Microsoft, and the others. Not exactly what you would expect from a classic dividend ETF. These companies do pay dividends, but the yields are relatively low. No doubt, they are fantastic businesses, but they are not high-yield stocks. They are more like dividend growth companies. You can also see this in the valuation. According to the fact sheet, the ETF currently trades at a price-to-earnings ratio of around 18. That puts it between the defensive Vanguard FTSE All-World High Dividend Yield and the MSCI World itself. If we look at the sector allocation, we see the same picture. Technology dominates. Financials and industrials, the usual dividend sectors, only appear further down the list. And now it gets interesting, because the ETF didn't always look like this. In mid-2022, the underlying index was completely changed. Originally, the ETF tracked the MSCI World High Dividend Yield Index. Back then, there was almost no tech exposure at all, just classic dividend companies, which I personally liked a lot, and that's why I bought the ETF in the first place. But in 2022, iShares jumped onto the ESG trend and simply switched the index, which honestly surprised me. The new index is called the MSCI World High Dividend Yield Advanced Select Index, and it is far more tech-focused. This shift completely changed the ETF's investment profile. However, to be fair, the switch hasn't hurt performance so far. On the contrary, once tech became the dominant sector, the total return improved noticeably, while the dividend yield only dropped a little. Looking at the total return, the iShares ETF has gained around 100% since launch, which works out to roughly 8% per year. In this chart, you can see the price return in green and the total return including dividends in blue. If the ETF had tracked the current index from day one, we would probably see an annual performance closer to 10%. Here we see a direct comparison with a standard MSCI World ETF. The massive outperformance of the MSCI World mainly comes from the fact that the iShares ETF followed a defensive, low-tech index during its first 5 years. I hold this ETF in my own portfolio, and so far, I'm very happy with its total return. Here you can see how the fund's assets under management have evolved. The sudden switch to an ESG-based strategy initially scared off some investors, and the fund size dropped by around 100 million euros. But it recovered quickly and attracted many new investors. Overall, the ETF is very popular and continues to grow steadily, which is a very positive sign. If you enjoy my content, a like and subscribe means a lot. Thanks. Before we talk about dividends, let's take a quick look at how this ETF actually selects its companies. The word quality is right there in the name, and the idea is simple. The ETF wants to pick only high-quality companies. So let's open the fact sheet of the underlying index and see what's going on. Because this is an ESG index, any company that fails certain environmental standards or is involved in controversial business activities gets removed. We won't go deeper into the ESG filter here. What matters more for us are the dividend-related quality screens that follow. Dividend Sustainability Screening. This filter removes companies whose dividends look unsustainable, either because they pay nothing, pay more than they earn, or pay unusually high amounts. Dividend Persistence Screening. This step excludes companies whose dividends have been shrinking over the past 5 years. Quality Screening. Only companies with above-average financial quality in their sector make it through, based on profitability, earnings stability, and debt levels. Price Performance Screening. And finally, the index removes the worst performers of the past year within each sector. These quality filters sound solid, but they're not exactly groundbreaking. The index may include high dividend yield in its name, but in my opinion, it doesn't really try to find true high-yield companies. Other indexes, such as the one behind the VanEck Dividend ETF, do a better job here. But still, the fact remains, this MSCI index selects around 200 solid dividend-paying companies out of more than 1,200 in the MSCI world, and that is definitely a strong foundation. All right, let's talk about dividends now. This ETF pays out quarterly, and that's another change iShares has made since the fund was launched. The switch from semi-annual to quarterly payments only happened in mid-2025. You can see this very clearly here on Just ETF. Even though I personally preferred the semi-annual payouts, I can understand why iShares changed the schedule. Most investors want to see cash flow more often during the year. To make the ETF more attractive, iShares simply delivered what the majority wanted. But be careful, some ETF platforms like Extra ETF did not pick up this change. That means the dividend history shown there is actually wrong. Let's move on to the dividend yield. Here you can see all annual payouts in euros. In 2025, the ETF paid out around 2.3%, which is really not a lot. I'll show all past dividend yields here. Since the ETF was launched in mid-2017, we can safely ignore that first partial year. We can see that the dividends have been very stable, which I like a lot. The bad news is that the dividend yield itself is relatively low. Since launch, the ETF has achieved an average yield of about 3% per year. In my opinion, dividend ETFs with such a low yield only make real sense if there is strong dividend growth on top. I'm talking about at least 7% growth per year. But since 2018, the dividend has grown by less than 3% per year, which is quite weak. So how do we make sense of everything here? Is it a bad ETF? Well, not so fast. Because the ETF changed its index in 2022 and has been much more tech-heavy since then, the evaluation becomes a bit more complicated. Here's the situation. From 2017 to mid-2022, the ETF followed a more defensive approach, with higher payouts but lower dividend growth. Since 2022, the new index has taken over, and it includes many dividend growth companies. From this type of index, you normally expect the opposite: lower initial payouts, but much stronger long-term dividend growth. However, even though the ETF now contains far more dividend growth companies, the dividends, unfortunately, have not grown. But, to be fair, the last few years have been difficult for dividend growth ETFs in general. Here, you can see the annual payouts of several dividend growth ETFs that normally grow their dividends by 7 or 8% per year. All of them struggled to increase their dividends in recent years. So, what am I trying to say? I want to make one point very clear. The dividend yield of this ETF is low, but strong dividend growth could compensate for that over the long term. In my view, the ETF has the potential to deliver that growth with its new index, but it simply hasn't had enough time to prove it yet. I'm not selling the ETF because I believe the dividend growth will only become visible in the coming years. That's it for the dividend section. If you're curious about how this ETF has changed over time, here's a quick summary. I've held this ETF since 2021, so I went through every single change myself, and I really hope iShares is finally done adjusting it. There's one more interesting thing I need to mention. After all these updates, the ETF now looks surprisingly similar to another strong dividend ETF, the Fidelity Global Quality Income ETF. That one isn't a high-yield ETF, it's more of a dividend growth ETF. I'm a big fan of the Fidelity ETF, and in fact, it's currently the largest position in my entire portfolio. So let's quickly compare the iShares ETF with the Fidelity ETF. If we look at the sector allocation of both ETFs, you'll see that they are almost identical. Tech at the top, followed by financials and healthcare. Even the top 10 holdings overlap quite a lot. The total return performance over the last 3 years, the time when the iShares ETF was already using the new index, turned out to be exactly the same. Now let's check the dividends. The payout months are identical, and both ETFs have relatively low dividends, although the iShares ETF pays out slightly more. Overall, you can definitely say that these two ETFs are very similar. The Fidelity ETF does use much stricter quality filters to select its companies, but right now the overall composition of both ETFs looks surprisingly similar. So it's definitely worth keeping an eye on them, because this iShares ETF might actually turn into a real competitor to the Fidelity ETF. I've held this ETF for several years now, and here's my honest summary. I find the total return performance of this ETF convincing, especially when you look at the last 3 years. But when it comes to dividends, it's a different story. The current dividend yield is only 2.3%, which is far from anything you'd call high yield. My guess is that the ETF has solid dividend growth potential, but we haven't seen it yet because U.S.-focused dividend ETFs have generally delivered weak payouts in recent years. Over time, this ETF has also surprised me more than once because iShares changed it several times. I originally bought an ETF that offered a defensive dividend strategy and paid twice a year. In the end, I now own an ESG-based dividend ETF with a strong tech focus that pays 4 times a year. Still, I didn't sell it because I believe it could be a good long-term investment. And I have to admit that since the index change in 2022, this iShares ETF looks very similar to my main holding, the Fidelity Global Quality Income ETF. Since I'm a big fan of the Fidelity ETF, I'm keeping the iShares one as well, hoping it develops just as well and eventually delivers strong dividend growth too. Now the big question. Would I buy the iShares ETF again today? No, I wouldn't. At least not right now. The tiny dividend yield only makes sense if there is strong dividend growth, and so far we haven't seen that. I don't expect the yield to rise, but the dividend payments themselves could increase over time. Before buying, I'd need to be confident that dividend growth is at least 6%. The ETF has potential, so I'd wait 1 or 2 years, watch how the dividends develop, and then maybe buy. But as always, this is just my personal opinion, and everyone should decide for themselves what to invest in. And now, I'd really like to hear your thoughts. Do you have this ETF on your watch list, or are you already invested? Let me know in the comments. That's it for today. Don't forget to like and subscribe. Thanks for watching, and I'll see you next time.